The Royce 100 fund is unique given that it has a particular focus on franchise or high quality businesses, as well as the fact that it's relatively concentrated with a maximum number of 100 names in the portfolio. Additionally, while the Royce 100 fund is at its core a small cap fund, it does have a little bit broader fishing pond relative to other Royce quality focused funds. The Royce 100 fund can invest in companies with market capitalizations up to $5 billion, which means not only can we take advantage of opportunities that may arise in the low end of the mid-cap market, but also invest in microcap companies, which is a less efficient but very attractive part of the market that Royce has been investing in for decades. Over the past several years, we've been finding some of the most attractive valuations among quality companies in the more economically sensitive sectors. Our largest sector weightings are industrials at about 29%, information technology at 25%, followed by energy and materials. In the industrials sector, we own several machinery, equipment, and business services companies that each dominate the particular niche that they operate in and are also well positioned to benefit from improved U.S. manufacturing activity, a rebound in commercial construction, as well as the eventual capital spending that's been postponed by companies over the past couple of years as a result of the tepid economic recovery that we've had thus far. A lot of our industrial companies have done a great job controlling their cost structures, and as a result, they're poised to have significant earnings leverage when the revenue growth does reaccelerate for them. And also, several of our industrial companies have international exposure, so they should benefit over time from an eventual recovery in Europe, as well as continued above-average economic growth in the emerging economies. Technology is another space where we've found a lot of interesting opportunities. We've actually found a lot of values in more traditional technology companies such as semiconductor capital equipment. Energy services is another area where we're finding a lot of attractive valuations among companies that earn high returns from providing the key exploration, drilling, production, and processing technologies that are fueling the ongoing North American shale gas and oil revolution. Historically, low-quality companies, defined as companies with very high levels of debt on their balance sheet or low returns on invested capital, have led small-cap performance in the early stages of an economic recovery. This cycle has been different in that low-quality outperformance has been much more prolonged. Given that economically sensitive sectors are the areas where we've been finding the most attractive valuations among quality companies over the past several years, we're optimistic about how our portfolios are positioned going forward.